Live today from DoubleLine Capital in Los Angeles. And Jeffrey Gundlach joins me now for a CNBC exclusive interview. It's good to be back here in Los Angeles with you.
Indeed. Welcome back. It's been a long time.
It has. We continue our streak of Fed days with you. Your reaction to the decision when you were with me in June, you said, quote, I don't think the Fed is going to raise rates again. Yet here we are.
Yep, they raised again. And obviously the bond market was way ahead of this. I mean, the warp function, which gives you a probability from the shape of the short and the yield curve, was over 99%. And I don't think we've had a meeting really since this all started where there's unanimity of opinion that there was going to be a hike, but that there wasn't even any debate that it was going to be 25 or 50. So they're obviously slowing down. The yield curve remains inverted. It de-inverted there in the aftermath of the regional banking problem with SVB, and that was a real recessionary sign. That was a moment where the markets were getting pretty nervous because the recessionary signals really, you get on watch when the yield curve gets very inverted. But as was brought up in some previous guests on your network today, it's when it starts to de-invert that you really get worried. And that stopped happening once the bank crisis calmed down. So the de-inversion is what you have to look for, and it hasn't really happened. I mean, we're back out at about 100 basis points, 2s, 10s, and we're really inverted from the 3-month bill to the 10-year Treasury. So we're watching for that. We're also watching for the gap between consumers' views of the present start to deteriorate and meet up with sort of what they have a view of the future, which is almost always on the pessimistic side. It's kind of weird. They always think it's going to be a little worse in 12 months. That has started to narrow a little bit, but not enough yet. So the other thing that's really important, I think, why I thought that the Fed wouldn't raise rates, and I think they shouldn't have. I kind of agreed with David Kelly, who was on right before I think the statement was announced, that they have the right to be and a reason to be careful here. And we've been talking about this the last few appearances I did with you, that inflation is coming down. And the headline CPI went from 9.1 to, I mean, people say it's 3, but amazingly, it actually has a 2 handle. If you go to the 2 decimal points, it's 2.98. And there's big numbers rolling off for the PCE, particularly the core PCE, in the next 3 to 4 months. It's possible that the PCE could go down to a 3 handle on the core level, really this coming month, because there's a big number rolling off. And that the headline PCE, which nobody really talks very much about, but it could go down into the 2s fairly soon. So we believe that the inflation rate is pretty much where the Fed should really be happy with where it is right now. You know, I did a funny study. I said, we keep getting this rhetoric of the 2% average inflation rate over time. Do you know what the core CPI average over the last 20 years per annum? 2.0%. It's exactly there. So we're exactly there. And if you took headline CPI and replaced the owner's equivalent rent, which is a big slug of the headline CPI, if you replaced it with actual home price movements from these indices, the CPI would not be 2.98% on the headline. You know what it would be? 0 if you replaced owner's equivalent rent with home price appreciation. So I think the Fed should take David Kelly's advice and try not to, just be on a programmatic sort of a situation, because the data seems to be getting a little bit better.
What I hear you saying is that the Fed should declare victory, in a sense, out of this whole thing and go home. That they shouldn't hike anymore because they don't need to.
I don't think they do. That was kind of my point of view when we spoke last time. So I think obviously what's really changed a lot is psychology. I mean, the stock market, particularly the NASDAQ, is up a ton. But one thing that's interesting, it feels like it's in a nonstop tear, but the asset class that actually has the highest return since the last Fed meeting, amazingly, is commodities. The BCOM index, thanks to a lot of the surge in agriculture, it's up 8%. The NASDAQ's only up 4% since the last Fed meeting. It feels like it's up a lot more, doesn't it? And I think that because of the tear year to date for the NASDAQ, I think there's an opportunity now for investors to be more value oriented. The Dow Jones Industrials is only up 8%. The NASDAQ is up, what, 38 or something like
Well,
this?
the Dow's catching up. The Dow's going for its 13th straight day of gains.
Every day. But still, I still think there's catch-up there. I think the manufacturing prices paid and so forth are looking somewhat encouraging. Also, on the inflation side, Scott, I like to talk about certain types of inflation numbers. One of my favorite is import and export prices, because they don't have any of these hedonics, they don't have seasonal adjustments, they're just prices. And they were just off the charts a couple of years ago. And that's why I said everyone is way underestimating what's coming in inflation. But people don't pay enough attention to this. These are down in the negative double digits now, year over year. The one of them, I can't remember which is which, but one of them's down about 11% or so, one's down 18% or so. That's a real disinflationary type of pressure. So I think that obviously if we just zoom out, when we dumped all that money into people's pockets and encouraged them not to work, it was obvious that we were going to have a bulge of economic, distortions. And one of those everyone should have known was going to be inflation. And that's still sort of bubbling through the system. One thing that a lot of economists talk about, and I think rightfully so, is M2 is negative year over year. And so when you start with that, you think, wow, inflation's really going to be shrinking. Mm-hmm. But one thing that people aren't really paying attention to is the bulge that occurred in 2020 and 2021 is still sort of with us. M2 is negative year over year, but the monetary base is still huge. There's still money sloshing around from all that stimulus.
But isn't that then why Powell suggests, and he did again today, that a recession is not his base case? That the cushion was so big, as you rightfully point out now, going in, that it can provide enough cushion on the backside as inflation, as you also said, is coming down. Yeah. Why does there have to be a bad ending?
Well, I just feel like just historical patterns, when you have inverted yield curves and you have credit conditions tightening, I just think it almost always just leads to some sort of a catalyst occurs, and you start to realize why the bond market is sussing out, this inverted yield curve and all that other stuff. But I think you need some sort of a shock to the system, and that hasn't been happening. It felt really bad earlier this year, but things have really calmed down. The bond market yields and the Treasury market are the same as they were at year end. They're the same as they were last September. They haven't changed at all. And that's led to a calming effect on psychology, because the volatility of the bond market was such a stomach churner last year, and it led to bad returns everywhere. But the bond market's been completely well behaved this year. Returns are not terribly high. If you go down in credit, you've got good returns. CCC corporates, which I don't really ever invest in heavily, but they're up double digits. Junk bonds, bank loans are up 7-8%. I mean, it's pretty good. And it's done it with not a lot of volatility, except for that window of the regional banking crisis that scared everybody.
Let me bring in our Steve Liesman, who was in the room, as you saw, asked the very first question. Steve, you heard Jeffrey Gundlach, and he's not the only one suggesting that the Fed shouldn't have gone today, that they shouldn't do any more because they don't need to. It's not exactly the tone you got out of Chair Powell today.
No, Powell is keeping all of these meetings live. He wants you to believe that there is still the possibility of a rate hike. He's not ready to say that inflation has been vanquished or that the Fed's job is done. Maybe we'll just listen to what he said about the possibility of a hike in September.
I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
Scott, there's a bit of a game going on here. Let me see if I can explain it. I'm interested in what Jeff thinks about it. I'm thinking about Powell like a jockey on a horse that's well known as a closer, and he's hanging back on the reins. He does not want that horse to run, at least not yet. because he does not want the market to believe that either the Fed is on a long-term pause or that it's eventually going to be cutting rates anytime soon. It doesn't want to have a dramatic loosening of financial conditions because it doesn't feel like he's really vanquished inflation just yet. So I think the reason why these quarter points hang out there, not that they're incredibly consequential necessarily by themselves on a nominal basis for tightening financial conditions, but they do, I believe, keep the market from running, and I think that hangs a bit like an anvil over the head of the market, the idea that you could get another quarter point down the road.
Jeffrey, what's your reaction to that?
I agree with that. I think that today's meeting I would characterize as being as bland as you can possibly get in that basically the answer to every single question is data dependency, which makes a lot of sense to me. The 2-year yield has not gone to new highs. The 10-year yield is lower than it was a year ago, or about the same as it was a year ago. And so I think the Fed should be data dependent, and they don't have a preconceived conception. It's quite clear to me. And I certainly agree, though, that they don't want to loosen financial conditions. But financial conditions have loosened. If you look at some of these indicators, and it's largely because, like, the VIX index is down. It's that volatility is down. That's one of the biggest drivers of why financial conditions are looser. So they actually are pretty loose if you look at those charts. And I do agree that the Fed wouldn't want to get a more overvalued, say, S&P 500 with a big running of the horse, as Steve uses the analogy. Because the S&P 500 is, I mean, people are expecting earnings to go up by 10% or so next year. But if they don't, if they only go up by half of that, you're looking at a pretty high PE, even on a forward basis of probably 21, 22 times. And that's kind of a lot. And a lot of this is driven, of course, by almost a mania type of feeling with that burst of the AI, the acceleration of the AI stocks, which reminds me a lot of the dot-com situation. I mean, it might end up being an excellent moneymaker, just like the dot-com stuff, if you held on to it, went to new highs, and some did super, super well. But it's got that feeling of a chase going on.
Steve, you've got a good handle on reading the room, I guess, as they say, and you know the chair well enough, I think, at this point, and certainly how to read him, and in not only his language, his body language, et cetera. Do you think that this was the last move in this cycle?
I thought you were going to ask me if you think he was going to go to another Dead and Company concert. I could have answered that question a little more easily.
He might.
He might. I don't think he's necessarily done yet. I think he's got a committee, Scott, and the committee was committed, not committed. They have strongly forecast that second hike in there. They may yet do it, but if the data does turn dramatically the other way, and some of the numbers that Jeff was talking about become reality, a 2% handle on maybe a headline PCE, that would be a very big deal. And you could see what would, I think, happen is I don't think Powell wants his committee to fray. And there would be, if there was enough data, another month of data. Friday, by the way, is a very important day. We get another round of PCE data. And then the next one after that's going to be important. The idea that if you get a couple of these in a row, Scott, remember, they were burned badly in January, and I think this was very instructive for Powell. Not only was the February data lousy, but they went back and revised the November, December, January data that showed that improvement. So he's going to be cautious here. If you do get a couple good ones in a row, I think he likes this period. I wouldn't say he's going to move in September. I feel pretty confident he wants to, if he does anything, do it in an every other meeting basis, even though he wouldn't commit to that. I think that's where that's how he wants to do things. But I think he comes back, and if the data supports it in November, he would do it if you remain, as he keeps saying, far above target. If you're still on a 4 or 5% core number, I think he'll hike again, if you ask me. I do want to say one other thing about his sense. He does seem pretty confident and feel pretty good about the outcome here of being able to bring down inflation pretty sharply and not have a big negative effect on the job market. I think he feels pretty good and pretty confident and feeling pretty successful about the idea of this soft landing, Scott.
Steve, I really appreciate it. I'm going to let you go. I love the engagement of you and Jeffrey as well. And I want to continue that, too, when we visit with you guys on Fed days. Thank you, Steve Liesman. Look, you guys don't think that Powell's going to pull this off.
The history has been some pretty aggressive rate cuts when those problems occur. And I'm wondering about the housing market, which has really baffled everybody, because you would have thought, with mortgage rates going up by 500 basis points, or 450 anyway, you'd have thought, with the home prices up so much and the mortgage rates up so much, that the housing trend would have weakened as it started to. But amazingly, they've gone up 4 months in a row. And the drawdown on the average median home price is almost non-existent again. We're almost near where we were. And so the reason that's happening, though, is because there's a huge bid-ask spread that's going on. The sellers are reluctant to sell unless they get a really high price that they have in their mind, because they've got this mortgage at 3%. And what are they going to do if they sell their house? I mean, their mortgage is one of their most valuable assets, actually. You can actually have your 3% mortgage and put in T-bills. Just put money in T-bills, and you get an arbitrage spread there of about 250 basis points. So the sellers are in a good, the owners are in a good situation, but the buyers, they have to confront the 7.25% mortgage rate on the 30-year bank rate as well. And their wages have been going up, which is good, but this recent move back up in housing prices is sort of problematic. I wonder at what point we're going to start seeing a shrinkage of jobs in the real estate market, because obviously this gap is creating what I call the bid-ask spread, if you will, on the home transactions. There's almost no activity at all. So this data could be highly misleading as a forward-looking indicator, because there's so few transactions that if there was a reason that would create catalyst for selling, I think that there could be a lot of downward movement in those markets that have gone up a lot.
At what point do you say, you know what, I'll be darned, they actually pulled it off? They actually pulled off a soft landing. They were able to crush inflation without crushing the economy.
If we get the 2s10 spread to be 150 basis points, and inflation is at a 2 handle and not a 0 handle, which is one thing that I still think is plausible here, then I think if that happened, you would say that we're in a normal situation again, and they pulled it off. But Powell has maybe learned from his big mistake of transitory inflation, because that's a real egg on the face sort of a thing. I mean, they thought it was going to stop at around 4 and it went to 9 on the headline CPI. I think he's learned from that, but I think he needs to focus again on the fact that maybe he's making an echo of that mistake. Maybe inflation's going to go lower with these import-export prices, with the balance sheet reduction, some of this. I'm not really worried about inflation in the short term at all.
What's the best play then right now for you? You still like the long end?
I have the long end. Long bond has not done much this year. It feels like it's been a lot of volatility, but it's only up a few percentage points. I still like, for the short term, and this is something that you have to be careful with, because if the economy rolls over, you've got to be dancing near the door. But I like the BB bank loan sector still. Their floating rate, their coupon just went up another 25 basis points today. They're cranking out returns in the first half of this year of about 8%. I don't like the lower tier of that asset class, because the interest rates risk is so high, and the yields they have to pay above the Fed funds rate, or SOFR, are so high that I think there's really growing default risk. And I think that's one of the stories that's going to be coming that may make it so that they can't say that they pulled it off, is the default rates could very well be going up as lending standards are tightening. And that is something that I think is in prospect for the next, 6 to 12 months. I still like the asset class, particularly the BB category at the present moment. The cash flow is really, really high compared to where it was even just 18 months ago.
You think the rates have peaked? We're looking at Treasuries right there on the screen. 483 is where the 2-year is today.
Yeah, I said, Scott, when we were down in Orange County back last September at an event, I said, I think rates of the 10-year's already peaked. And I was right. That's the 10-year has been very, very calm, and is not even that, it's fairly far below where its peak was. I mean, it's about 40, 50 basis points below. And even the 2-year Treasury has peaked. with the Fed raising rates, since the regional bank crisis, it hasn't put the 2-year into any sort of form of distress. So yeah, I think rates have peaked. I'm completely comfortable owning Treasuries. I say I like these bank loans, the higher quality bank loans. I think the dollar has started its weakening trend. We see that with the commodity price bump. I don't mind commodities that much now with the dollar weakening. And I think there's a good opportunity for emerging market debt investment that, unfortunately, I think is a little bit late because the spreads have tightened so much. We're down to only about 415 basis points on a basket of EM. And the average spread has come in a fair amount, but what's really come in is the dregs, the triple C categories, thanks to the stock market going up so much, particularly the NASDAQ, from about February or March on, I guess. There's been a little bit of a rush to lower credit and grabbing at yield and stuff like that.
You still like India?
I do. It's doing okay this year. It's not up as much as the United States, but that's a long-term play. I think the demographic setup there and the need for political and legal reform is very acute because they need to deal with the same type of demographic bulge that China was faced with about 30 years ago. And you know what happened to China? Their GDP went up 10 times or more over that time period, and now they've went from 10% of the U.S. GDP to 75 or 80. I think that's going to happen in India. And so I've been invested there for a long time, and I just would put that in a core portfolio and just don't worry about it because it's a long-term play for your grandchildren's college fund.
When do we get the first rate cut, do you think?
I think the first rate cut will come next year. I think we'll get it. I think it will be encouraged by ultimately a drop in 2-year yields. And I think the steepening yield curve there and the lower inflation rate is a big part of that. I think we're going to see 2% inflation in the PCE. I don't know about the core PCE being quite that low, maybe at a 3 number. I think I think CPI is going to be living in a 2 handle. And I think we're going to get there in a few months. And I think we're going to stay there. I mean, who knows? I mean, oil prices go to 200 or something, all bets are off. But I think it can stay there. And that's why I think the Fed, what you said, I mean, I think they sort of have a little bit of a mission accomplished mindset, or at least they're entertaining that idea. They're playing with it, because this meeting was a lot different than a couple meetings ago, where there was dissensions and is it 25, is it 50, and now it's just unanimous 25, data dependent, data dependent, data dependent. And I think the data is not going to be supportive of more rate hikes.
I mean, he's still fixated on the core, as he said today, which he suggested is still too elevated.
Yeah, the PCE core, but that's coming down. There's 1.8% that's rolling off in the next 4 months or so, and it could drop another percent. So that number could definitely be in the 3s, below 3.5 this year, before the end of the year. And I think that if you have the core PCE in the below 3.5, and you have the headline CPI at 2.25, which is our base case based upon today's commodity complex, I don't think there's any reason to hike at all.
I mean, he still suggests that it's just way too elevated, and that it's going to be more sticky, perhaps, than people would suggest.
That's why I say I think he's doing an echo of his transitory mistake. I just think it was so obvious that inflation was going to go up much higher than the Fed thought in 2022, and everything that we're looking at, we think it's going to be the trend remains in place for these lower inflation prints, and I think Jay Powell is just a little afraid to buy into that, because if it doesn't happen, he's got a problem. But I think it's going to happen.
Well, also, you have to take into consideration, too, I think what Liesman in some respects suggested, and maybe you did as well, words versus action. Right? They have to talk the way they are. He has to say the things he is saying on days like today. Whether the actions follow the words remains the central question.
That's right. But nobody's even pushing back in this present moment, this present environment, that the Fed just says, we might raise, we might cut, we're data dependent. The market is completely accepting of that. And I think that's...
Well, don't you want that? Why wouldn't you want that?
I'm not saying it's a bad thing, and I think that's why the stock market went up so much in the middle of this year. I think that they were being increasingly calmed that we're slowing the pace. Right, we went from 75 to 50 to 25 to nothing, and now at 25. I mean, the trend is fairly obvious here, and the market moves ahead. I mean, it discounts. It's amazing. Last March, everybody thought the bears, it was like all-time bearish readings. And, we have a big rally, and now everybody's feeling comfortable again, and kind of Fed's feeling good. But, things don't stay stable indefinitely. It's just sort of been a good run of economic statistics.
We will make that the last word, and we will look forward to speaking with you in September.
September it is. Yes, we have two job reports, 2 rounds of inflation reports. And I think they're going to be such that the Fed won't be raising rates. But I was wrong last time, so I'm wrong 30% of the time. So don't hold me to everything I say.
All right. Well, you'd be in the Hall of Fame if you were a baseball player. So I appreciate you having us back.
Thanks, Judge. We'll look forward to the next one.
All right. That's Jeffrey Gundlach.